Good morning and welcome to Money Control. Well, the Nifty has been at kissing distance from the all-time high but has not been able to surpass it yet. Today, of course, the mood is a little more somber because the Nifty is down about 80-100 points right now. But the overall narrative around the India story continues to be bullish. And to talk about the real economy, the change that is happening globally in terms of our perception and the way ahead for markets, I have with me a very special guest, Prashant Khemka, who is the founder and CIO of WhiteOak. He's seen both sides. He's seen India from India. He's seen India from New York. And he has a pulse on both the global investors as well as Indian investors. So let me just shoot the question straight away. Prashant, first of all, thank you so much for joining me this morning. It's such a pleasure to have you. The first question is, how optimistic are you? How soon are we going to see the all-time high levels being crossed? And what is your guess that we will surpass 20,000 this year on the Nifty?
Certainly. No, thank you, first of all, Mahalakhsmi, for having me here on the on air with you. Certainly, see, having, as you pointed out, invested over time, I've come to believe it is in nature of the markets to keep moving higher. Obviously, they don't move up in a straight line, but over time, if the economy is doing well, corporate India is doing well, then just as it has happened in almost every market around the world, the market provides returns, equity returns, in line with the nominal GDP growth rate. So if you look back last 10, 20, 30, 40 years, there have been hundreds of all-time highs, and we'll soon, create new all-time highs. Hard to, put for anyone, impossible, I would say, not hard, impossible to put a specific time or date on when it would cross. But if you ask me, the base case assumption would be that the market would provide double-digit returns over the next 12 months, and in doing so would easily surpass and create several new highs along the way.
So, Prashant, there are two ways to look at these market tops. One is that the traders definitely feel that crossing of a all-time high or a longish period of high is a sense of optimism. I mean, it's strong momentum at play. But slightly longer term investors would probably be skeptics and say that, hey, there is probably too much exuberance around market tops. How are you approaching it, and what is your sense?
See, if you, Mahalakshmi, look at the index over the last year or so, or year or two, we crossed 25,000 last in, I think, November 22 or so. So it's not been like a very recent surge to all-time high. The market has had a little bit of time correction. We crossed or we approached 25,000 actually back in 2021. So it's coming up to 2 years that the market has been, more of sideways. So it does not suggest at least the graph doesn't suggest that it has been a unidirectional move over the last year or two, like it was in 2006-7 time frame. If you look at the graph at that time, the new highs had a very different picture than the highs we are doing now. I think it is supported by strong fundamentals. You've had corporate performance that has been very robust, definitely very robust compared to the last 10 years of corporate performance within India. So pre-COVID, let's say, we had for about a decade or a dozen years, corporate earnings had grown at only about mid-single digits. And last 3 years, corporate earnings have grown in the high teens or somewhere in that neighborhood. Also, relative to global markets, be it developed world or emerging markets, corporate performance has been much better in India, by and large. And so that is what the market is capturing. And the multiples, if you look at, they are within the range of historical averages. Obviously, it all depends on which multiple and what time frames you're looking at. But if you look at the last 10-year multiples of the market, it is within plus minus 10% of that.
Sure, absolutely. So before we get into the valuation part and all of that, some more fundamental questions, Prashant, which is that if you see the momentum around flows has been very strong over the last during this rally. And do you see this as a more permanent change? Because the narrative around flows this time around, I mean, there was a lot of exuberance around China reopening at the start of the year. So both flows were also going back to China. But that has not really panned out the way investors were expecting or projecting. But since February, March onwards, again, this anti-China sentiment has been more pronounced. Whether you look at fund flows or economic indicators, the narrative seems to be strongly in favor of India, and the anti-China sentiment seems to be growing. So, what is your sense in terms of how credible is this narrative? Can we really build on this over the long term? By long term, I'm not taking a really long term view, but over the next 3-4 years, do you see this momentum and narrative continuing and gaining more credence?
No, very valid points, Mahalakshmi. I would say there is a lot of credibility or a lot of substance in that outline that you provided. See, it is a confluence of geopolitics, economic policies, corporate world actions, which obviously are partly guided by the first two, geopolitics and economic reality. And then the equity markets have, always trying to reflect that and anticipate the future course, right? So if you look at over the last decade or so, there have been a few events globally that have been more favorable towards India in the relative context, relative to China. You mentioned earlier during the introductory remarks that I had the opportunity to view the Indian markets or have a perspective from New York or the US, as well as obviously grown up and lived long years in India. So I'll just share that in 95, when I first went to the US as a student, I was in for a shock, a bit of a culture shock, as people say, culture shock, right? So this was the culture shock to me, that in India, we all always have been so preoccupied with what's everything related to America and the US, yeah. Whereas when I reached US in 95, I was quite shocked how indifferent they were to India. They had hardly any knowledge or cared for what India stands for or what is India's position in the global scheme of things. They were completely centered and preoccupied by China. If you pick up the newspapers back then of 90s or around that time, probably the mention of China versus that of India would be, I don't know, 50x, 100x or some such crazy number. I haven't done it, but some such large number. Today, India has become a lot more mainstream. And if I were to now narrow the time zone to more the last 10 years, if you will, some of the key events that have tilted the balance geopolitically in India's favor. Again, I'm keeping the context mainly to relative to China. First, and I'm only mentioning what I think are the major ones. There are other factors as well, but the Trump presidency, he was very obviously and strongly had a aggressive posture towards China and the American dependency in terms of imports on China and what he believed are fair trade practices and so on. So his tone and his actions, laid the initial, incentives for corporate America to start thinking about diversifying their supply chains from China. Because if Trump, and he was showing it through his actions by implementing tariff and non-tariff barriers. So that could have posed problems for corporate America down the line if that continued. And that's why corporate America started thinking beyond China in terms of supply chains. And India was one of the obviously potential destinations. Then came COVID, where China had its own very rigid COVID zero policies, where supply chains got disrupted and a lot of companies around the world suffered losses and loss of production. And that further strengthened their resolve and further highlighted the importance of not being dependent on a single country, which can have quite extreme policies, very different from what the rest of the world deems sensible. And then, third, very crucially, was the Russia Ukraine war, where the West unanimously sanctioned Russia, and anyone who had exposure, disproportionate exposure to Russia suffered very badly, and anyone who had exposure to Russia suffered losses. So this third event further in the context of China-Taiwan relations brought forth the risk and boardrooms of every company in the US or in Europe or the Western world or anywhere got besieged with the problem of dependence on China, where such existed, on how to diversify that supply. What is the business continuity planning in case one of these things go wrong again with China? And India then obviously comes up as a very attractive destination by virtue of several factors. It's a democracy, first of all, so the actions are not as arbitrary as some of the actions we've seen from China or Russia in the last few years. Secondly, very importantly, it's a very large domestic market. So setting up production facility in India not only helps diversify the supply chain for these corporates, but also helps to more cost effectively supply to the domestic market. And coupled with it, the government's policies, which further encouraged and incentivized the establishment of manufacturing facilities in India and discouraged, unlike more so than ever before, imports. All those played an important role in making India as a very desired destination for corporates around the world, for doing business, for setting up factories, and so on and so forth. And then this is in the real world. And then at the same time, obviously, the equity markets were reflecting a lot of these developments. China in particular suffered tremendously by the unprecedented third election of Xi Jinping in an unprecedented third term. So markets value and put a premium to democratic countries, and China in some way went in the reverse direction. So there was a massive correction in multiples in China, and investors tend to follow market performance. And since India did well and China did poorly, there has been over the last 12 months a growing inclination amongst Western investors, foreign investors, to increase allocation to India. A lot of investors who earlier used to have multi-regional allocations like EM allocation, Asia allocation, global equity allocation, and a China single country allocation was limited to China, amongst emerging markets. Now they are doing India as a single allocation. Some of them at the expense of China, others alongside China. So long answer, but there are both aspects to it: the real world, which incorporates geopolitics and corporate actions, and the equity markets, which then reflects the same.
Absolutely, Prashant. This is a narrative that has, of course, been built for the last 4 or 5 years. It's been an ongoing trend as far as the stock markets are concerned, that China plus one set of stocks have done very well. And now, of course, you're also seeing in the real economy a lot of new investments coming through and all of that. I wanted you to expound a little bit more on the fund flow side. What kind of funds are you seeing coming into India now? because one is reading in in newspapers like the Financial Times that the clamor for ex-China kind of products is really rising. Investors are really looking at ex-China emerging market indices, or Asia ex-China is a new benchmark that is gaining credence. Do you see that as a big component? Because the insecurity that we have always is that, because post-pandemic China has not done well, it has not delivered. Therefore, there is, it is being de-emphasized. And the moment there is some kind of a resurgence in performance buoyed by the economic indicators, money will flow back into China. In fact, that's the conversation we had at the end of last year when we were trying to see what could happen this year. Have we just parked that argument aside for the time being because the mood has changed? Or is this a credible narrative that we can rely on?
So, see, this is a narrative that lasts as long as the markets perform well or poorly. So, as long as Indian market performs well, that is positive, and as long as Chinese markets performs poorly, this is negative. But more seriously, see, the question of flows is a far more complicated one and nuanced one than we generally discuss. So, there are, out of the $700 billion that is invested by foreigners in Indian equities, one have to realize the vast majority, 70 to 80% of that, there are no firm figures, but by an estimated 70 to 80% comes from multi-regional funds like Emerging Market Fund, Asia Fund, Global Equity Fund. Only 20 to 30% is India dedicated. Yeah. So even if the India dedicated piece is receiving inflows, however, if globally investors are negative on equity markets and particularly on EM overall, like was the case last year, people were negative not only on China, but because China is such a large component of emerging markets, people were negative on emerging markets as an asset class. So there were massive outflows from emerging markets. And guess what? India is around 15%, 15% of emerging market portfolios around the world. And there are like trillions of dollars, by some estimates, $2 to $3 trillion of money in emerging market as an asset class. So last year, let's assume in a year, like last year, I don't have the specific figure off the top of my head, but if $100 billion out of $3 trillion, let's say, were to flow out of EM as an asset class, automatically 15% of that, which is $15 billion, would flow out as well of India. Now, the India dedicated flows, even if they are positive, they might not be so large to offset this $15 billion outflow. Yeah? So last year, I think, was a case which was one of the largest outflows from India historically, but it wasn't, from our perspective, our own experience as a manager, as one of the largest manager of foreign money, but also from what we understood, it is outflows related to multi-regional funds like EM, Asia, Global Equity, and so on. India wasn't huge. India dedicated might not have been a huge positive last year because overall sentiment with the Fed increases and the equity markets being down globally, the sentiment towards equities in general was weak. So India might not have had, on an India dedicated basis, large inflows, but there weren't material outflows from what we can understand on India dedicated funds. This year, as we speak, the EM outflows have stabilized. I again don't have the specific figure. There might be small year to date that might be positive as well. But the India dedicated flows have also picked up quite substantially over the last couple of months. And the inquiry levels, to your question, where are we seeing it from? At least at WhiteOak, we are seeing it from across various geographies. So be it corporate pension plans or university endowments or other such sources of pockets of money from US or Americas, or the private banks in Europe, pension plans in Europe, and so on and so forth. It's from across board for the reasons that we discussed just a few minutes ago. India has elevated or bubbled up as a standalone allocation, unlike ever before. We've become the fifth largest stock market. Economy is rising through the ranks. So investors globally are increasingly deciding to make in India a standalone allocation rather than just a part of a EM fund. And last, it's not something that just switches on and off. I think it is this aspect of India becoming standalone is a bit more structural. Obviously,
Right.
if things go wrong, then they can always reevaluate. But that is one positive contributor, big positive contributor in our assessment to the flows we've seen in India dedicated assets this year. And on the negative side, EM outflows are not that big, and hence we are seeing a surge in positive inflows in India as a
Sure.
combination.
Prashant. So a question related to that is this, anti-China benchmark, because my understanding is, correct me if I'm wrong, even if there were to be outflows overall from emerging markets, and if people latch on to the emerging market ex-China kind of product,
Yeah.
by sheer change in the weightage for India,
Yes.
one can make a case for flows, at least passive flows, to be a lot more positive.
Certainly.
Again, is that a credible theory?
So Mahalakshmi, I would say, and we launched the Emerging Markets Fund, our WhiteOak Emerging Markets Fund, in June of last year. So we are just going to next week complete 1 year of that. At the time of launch, there were several inquiries from clients that why don't you also do a GEM, whether you can just do GEMX China or can also do GEMX China. Those inquiries and requests gained momentum until October, when China bottomed around the re-election of the president there. But as Chinese markets started bouncing in November, December, January, people forgot about GEMX China. Yeah? And only now, again, recently, last few weeks, those requests have started flowing in again as Chinese market has done very poorly. So I think there would be a segment of the market that would request and would invest in GEMX China. But I think that would remain very small, at least in the coming few 2-3 years. It's not like it's nowhere near Asia ex Japan. Asia ex Japan is a big asset class because Japan got elevated to developed world status. As long as China is in the emerging markets index, which there are no signs of any change to that, it would remain 30%. I think a GEM ex China mandate would have takers, but would remain a small single digit fraction of the overall GEM asset class.
Sure.
At least in the next few years, China has to do something a lot more wrong, which they could do, but a lot more wrong before that thing were to happen.
Sure. Prashant, now coming back to valuations, if you look at the emerging markets, obviously India has always been at a premium to the rest of the emerging countries, and rightly so, because the basket of stocks that you get to pick here, whether it is IT or FMCG or, most of them are more domestic oriented, the growth is stronger, more insulated from, the rest of the world or exports and commodities and so on. But the new money that flows in, how wary is that of valuations? Are they willing to consider paying this premium? Of course, now there has been a lot of compression in valuations, so it looks a lot better than, say, 2021 or 2022. But even then, when you compare against other emerging markets, you do look expensive. So the new investors that are coming on board, how do they look at this premium?
So besides, so first of all, let me say it's true in individual stock market also. If you look at Indian companies in any sector, let's say staples, there are certain, I can't name names, but there are certain staples companies, not only multinational consumer staple companies, but domestic consumer staple companies also, which trade at very far higher multiples than the sector. And people always complain that they are at very high multiples and expensive according to them. But these continue to trade that way, and there are large enough number of investors who continue to invest in them. And one can argue there are logical, sound reasons why, and oftentimes it has to do with corporate governance besides growth. That these companies trade at a high multiple. Similarly, India has always traded at a premium multiple, besides some of the factors that you mentioned, which is domestic growth is higher and so on. An important fact, very important factor, something we've written and talked about extensively. One of the newsletters we had in 2021, end of 2021 newsletter, we had dedicated on this subject. Very timely because it was written just ahead of Russia's invasion of Ukraine and China's dramatic fall. An important factor is democracy. If you look at data of markets around the world, democracies have always traded at a substantial premium to authoritarian countries as a basket. Yeah. And the reason is better protection of property rights because of separation of powers that exists in democracies. Now, yes, you can argue many of these emerging market democracies, no democracy is perfect. Neither is US a perfect democracy, nor one can argue India is a perfect democracy. But there exists separation of power, which lends greater protection to property rights. So a leader cannot, of any party or even the governing party can't one fine day say, this industry has no purpose to exist or should not make profits and completely annihilate the industry. With all its shortcomings, India is a well-functioning democracy with good property rights. And ultimately, equities are nothing but contractual rights to cash flow of underlying companies into perpetuity. So it's a right that is valuable only if investors believe that right is enforceable in the courts of law. And generally speaking, in democracies, these are more enforceable rights than in authoritarian regimes. And hence, markets in democracies trade at a sizable premium, all else equal. So think of it as as corporate governance at national level. Just as within a sector, any sector in India, companies with good corporate governance trade at a substantial high premium, even for similar growth rates. Same is true at corporate country level. Country level governance is superior in democracies than in authoritarian regimes. India being a well-functioning democracy, the multiple is first and foremost, I would say, more so than any other factor, growth or domestic exposure and whatnot. More than any other factor, the multiple premium that India has reflects the well-functioning democracy and separation of powers, and hence the protection of property rights that India provides to investors globally.
Sure, point well taken, Prashant. But a lot of your peers will take offense to the distinction you made between, multinational companies and Indian companies, with multinational companies being better in terms of governance.
No.
That's not a story that cuts ice with Indian participants.
Sorry, if I misspoke, I want to clarify, but I don't think I misspoke. If we were to rewind and listen again, I said not only multinational companies, but several well-run Indian companies as well trade at because there's a perception that all the multinational consumer companies trade at a premium. That is not the case. There are so many
Indian companies.
Indian consumer staple companies which trade at a high premium as well because they're well governed.
Fair enough. So, one question I wanted to ask you is, Prashant, again, because you now have the benefit of a global hedge fund and you also have a domestic fund. We always see that whenever FIIs start to buy, the domestic mutual funds are trying to sell off and the other way around. Why does this happen?
See, I would say, Mahalakhsmi, I've personally not observed that closely the flow data, but assuming that is the case, first of all, the global flows are not as dominating in the Indian market volumes as they once were. And we are talking institutional flows, let's say. So the global flows in, say, the prior decade formed lot larger percentage of volume would be my again, I don't have the numbers in front of me, but like in 2007, when I, at my prior firm, I launched the India strategy, the largest funds and managers were all FII India managers. They were managing individual funds that were $5 to $10 billion in size, whereas the largest mutual fund in India, and I assume for insurance companies even smaller, but the largest mutual funds in India were like $2 billion or that. And that's why the market was so preoccupied, investors so preoccupied, and the sell side was so preoccupied, and the buy side was so preoccupied with what are these large fund managers who manage $5 to $10 billion at that time was humongous amount of money for the Indian mutual fund or Indian institutional money management industry. Today, if you see, there are individual mid cap and flexi cap funds in India which are $4 to $5 billion or higher, whereas the largest single funds from foreign investors is smaller than that, is like $2 to $3 billion. So the table somewhat has, tables have reversed. The overall pool of money invested in Indian market by foreign investors has grown over this time frame, but individual fund managers don't wield that much. It's not as concentrated as it used to be 15 years ago, is first point. And secondly, the domestic institutional investors have grown much faster than foreign institutional investors, and hence it's more of a comparable size now amongst global investors. So if you look at domestic AMC industry now has about $200 billion invested or manages $200 billion of public equity money, somewhere plus or minus, right? And as I was saying, out of $700 billion that foreigners have invested, about, I would say, $200 billion might be in India dedicated money. Yes, there is another pool of $500 billion invested in India that comes from the multi-regional investors as well. So to your question of when foreigners are buying, see, I think it's a bit of arithmetic as well. If there is net buying from foreign investors, there has to be net selling from domestic investors. Otherwise, where would the foreign investors create the net buying from, right? And the domestic investors, the net selling from domestic investors would be a combination of individuals as well as institutions. Yeah, but other than that, I don't have great insight because I have not evaluated that data that closely on this buys and sells.
No, it will be very heartening to see, that portion really coming from companies by way of, fresh issue, which goes to power growth, because that will be the real sign that companies are galloping and trying to embrace for higher growth. But that apart, what are the risks that you see on the global horizon now? Until 1 or 2 months back, we were still thinking that the peak in interest rates is past us, but there is a surprise from Bank of England, Bank of Australia, and a couple of other small banks, central banks as well. And of course, Powell is also saying that we might have to do another couple of rate hikes before we peak. So, do you see any fresh worries emanating now, or is this something that is already factored into the market?
Certainly. So see, these I think are factored into the markets. Yeah. So the biggest risk is always the risk of the unknown risk. Like COVID was an unknown. Russia, Ukraine was an unknown.
Right.
Inflation, interest rates, these are all known unknowns. And these are all reflecting the current consensus estimate on these risks. So the market are very efficient in that sense. What Powell is saying or thinking, the market reflects that in almost real-time basis, right, and factors that in to the extent that it is relevant and important. So I don't think that if Fed increases interest rates a couple of times, as recently just yesterday or earlier this week, the commentary suggested that is going to be a big negative surprise to the market. Now, if something unanticipated to and even in the known risks or the known unknowns, if the degree that those risks manifest to is much higher than anticipated. What I mean by that, inflation currently, the anticipation is inflation would gradually come down over the coming months and years. If there is some unanticipated reversal that inflation starts going higher, then that could be a risk to the markets. That is not the base case for anyone, but that is a risk. Similarly, COVID and Russia, Ukraine now have become business as usual. No, COVID is still there. COVID has not disappeared, but nobody talks about COVID as a risk today. Nobody worries about any new variant that could be substantially more harmful. So it has become business as usual. But if there is some unanticipated development on that front, that is an unknown risk. Similarly, Russia, Ukraine has become business as usual. Now, if some either party pulls out something from their pocket that shocks the world again, then that is a risk. And then there is a risk of, as I said, unknown. But otherwise, these are known risks. Obviously, India's specific risk, central elections are always an important aspect, which are due within the next 12 months. Market always prefers stability and continuity and wants to avoid uncertainty. Market has its strong preferences at this time, and market believes that's going to be the case. If for whatever reason there is low single digit probability or whatever probability, if that were to not be as strong as market is expecting, then that could be a potential risk.
That's exactly the question I was coming to, Prashant. So ahead of elections, what's been your experience in the past? Do foreign investors kind of become a little wary? Do flows to country-specific funds slow down? Is there any insight from past behavior?
Yes, in the run-up to the elections, there is an added, and I would say towards closer to the elections, just as the media starts talking about it, investors start talking about it, then there is a little bit of an addition. I mean, obviously, there becomes an additional unpredictable factor in decision making. So some investors do pause and say, let the event take place, and then we would invest. Otherwise, investors take cue from the market. If the market continues to chug along, and as we were discussing early in the conversation, if market keeps breaking new highs, investors globally would believe that the outcome from the election is certain, so no point in waiting and missing out few percentage points of further rally, and they would continue to invest. If markets are choppy and on the downside, and there's a lot of media reports and events that suggest that the outcome of the election is uncertain, and in that case, you may see more of some withdrawals or pause in fresh allocations. So market plays a very big role. The investors worldwide are no different than our domestic investors who like to invest as the markets are rising and stay on the sidelines if they show signs of volatility or decline.
Sure, absolutely. Last question. How is your positioning in your portfolios right now? What are you bullish on? What are you bearish on?
So we are, as Mahalakhsmi, very bottom-up driven. The team looks for the best ideas, both as a combination of strength of the business and attractiveness of valuation from each sector. We do have a strong focus on governance. So sectors, there are certain sectors which generally have a larger number of companies with stronger governance, and certain sectors where it is more challenging to find companies with strong governance. Though even if it is challenging, we continue to look for such companies in those sectors as well. So having said that, the sectors where the team structurally tends to find more opportunities, because the governance aspect doesn't change overnight. I would not mention any other sector, but I can mention real estate as a sector, because even company managements in real estate sector agree that most of our community is full of crooks. Yeah, so they don't get offended. If I mention any other sector, corporates tend to get offended. So in real estate, our team is unlikely to find many opportunities because just the opportunity set is much smaller than what the number of names in real estate would suggest. Whereas sectors like banking sector, there are a large number of very well managed private sector banks in India. Not just banks, but non-banking financial companies as well, and as also non-lending financial companies. So we tend to always have, and this fact hasn't changed over the last 20 plus years. Yeah. So we always tend to have probably the largest allocation amongst financials in the portfolio. Also, consumption broadly related is very well represented in the portfolio, not just consumer staples, but also including consumer discretionary, which includes auto, retail, and so on and so forth. Besides this, we always tend to have good amount of allocation in IT services. I understand last 12 to 18 months have been difficult for the sector, but IT services also you find, I mean, it's been a massive wealth creator over the last 10, 20 years because some extremely well-run companies from India and across the market cap spectrum, large, mid, and small. We have companies in these sectors. So IT and healthcare also, we tend to have. Healthcare, I would say more generally, healthcare and also I'm talking about the larger sectors, then obviously there are sectors within these broader classifications like, chemicals as a sector.
Right.
We've had good success over the last many years, finding very good ideas, though it's a niche, small sector in the overall context.
Sorry. This is truly the last question. Is there any aspect or segment of the market that you are a contrarian? You have a completely different view from the market?
I would say at this time, IT services would probably be one where we remain constructive from the long-term perspective and have good exposure, whereas market has, become increasingly negative given the expectations of slowdown in the US. We don't disagree with the expectations of slowdown in US and some demand slowdown and whatnot. But as I was saying earlier in the conversation, value of any company is present value of future cash flows. And those are future cash flows into perpetuity, not just next year or two. So yes, there is potential that some of these companies may see weakness in their cash flows or revenues and cash flows over the next year or two. But we believe the valuations are very attractive. Selective for select companies. We're not talking about overall sector here, but the companies that we've invested in, these are very well managed companies and valuations are very attractive, that we are happy to see through that year or two of weakness in the demand environment.
Prashant, can you really see, I'm sorry, I'm really tempted to ask this question because this is a very vital point. Can you really do a DCF kind of approach for IT companies, tech in general? Of course, the market is doing that for all kinds of tech companies, but we're all given to understand and learn that tech is very easily disrupted. And therefore, I mean, your visibility into the future, you have to be conservative about that. So if you just wind back to, maybe 2012, 14, etc., there was this narrative that, there was a huge threat to Indian IT because all these chatbots, I mean, automation will essentially kill the industry. And this is kind of, it just keeps yo-yoing, and now there is this huge narrative around generative AI. One side is saying they will leverage it. There are, I mean, how do you balance these things, especially when you have to think about, long-term growth and arrive at a value? How do you look at these forces and counter forces?
Certainly, Mahalakhsmi. Very, very good and interesting question. We can discuss this itself for another session. But see, in investing, the multiple aspects, obviously very crucial. There's no substitute for fundamental analysis and understanding of the industry. What kind of threats, competitive threats, technological threats, and all these how they might evolve, trying to understand these. There's no substitute to that. Once you have done that, or alongside that, I would say not necessarily sequential, but alongside that, valuation is very crucial as well. For in investing, ultimately the returns that you earn are going to be a function of the valuation at which you invest. So it's not a one versus the other in any sector. It's a combination of both, and both are crucially important. Understanding of the business prospects, fundamentals of the industry is very, very crucial. I'm not trying to say that's not important, but once, I mean, you would, regardless of how predictable a business is or is not, you would still need to value it. For valuation of any kind of business, pretty much, DCF is the most fundamental way to value them. Yes, people, obviously, there are some, like in case of banking, you have to adapt that or modify that. It's a heavily leveraged business model, and there's a different perspective that you have to bring, additional perspective that you have to bring in. I'm not denying that, but DCF remains the most fundamental way. What is value of a business if it is not present value of future cash flows? That's the most fundamental way of valuing companies. And it is as applicable to tech companies, new age tech companies, old age tech companies, consumer staple companies, or any other companies. And just as a further point, I would note, Indian IT services company is a fairly stable business model over time compared to the true new age tech companies that obviously are dominate NASDAQ and certain markets. In India, IT services are more staple kind of technology. Yes, from time to time they face these obsolescence or substitution threats. Like Y2K was supposed to, after Y2K, Indian IT companies were supposed to go out of business because there would not be enough work left for so many IT companies. Then post 2007-8, after global financial crisis, since BFSI in the US constituted close to 50% of the revenues, these companies were going to lose half of their business, or so was the expectation. And then there have been several other events from time to time. Digital and all was big. Cloud was a big worry for IT companies, that everything would be on cloud. You would not need, so many enterprises would not have reason to hire IT services companies. So cloud, digital, all these were supposed to be, and this is as recently as 2017, when we had very sizable investment and made very strong returns, when it turned out that cloud did not put Indian companies out of business. And so now it is generative AI. We are not dismissing all this. Yes, certain pockets of IT services, just like each of these prior events that I highlighted, did damage certain pockets of IT services business. But then other parts of the IT services business thrived. Yeah, ultimately, globally, companies have to continually invest in technology to stay ahead of competition and become more productive. If they save money in one area, let's say due to application of generative AI, there is still an endless list of projects with them to deploy those savings. So you have to evaluate these threats. They're very important. But I think just writing off a sector every time such a threat emerges, if you start doing that, then you would have written off IT services industry at least 4 times over the last 25 years.
Point taken. Thank you so much, Prashant. It was such a pleasure talking to you. Thank you for taking out the time, and look forward to the next time.
My pleasure. Thank you so much, Mahalakhsmi, for having me here and for taking the time for a very engaging session. Thank you.
Thank you so much.